Hello YouTube and welcome to another video where we're going to talk about position sizing and why it matters. So let's jump right into it. So the way we're going to start with this is understanding that position sizing is dependent on the size of your portfolio, of course. So we've got a couple of different columns here. So we can talk about examples that will hopefully apply to about all of you unless you're working with more than a $5 million portfolio or less than $1,000. Those are kind of edge cases that there probably aren't that many of you anyway, so you'll have to do some research on your own outside of watching this video. But generally, where we want to start is understanding conviction, right? And anytime that you're getting into a play, you have to obviously believe in it. Otherwise, you're truly just throwing money and gambling to see what happens. So the way that I like to look at this is with a gut check of what's your conviction? You don't need any math behind this to decide what your conviction is. You just need to be able to decide if it's low, medium, or high. So in the case of this little chart we've got down here, for low conviction plays, I usually recommend anything from 1 to 2%, and even less than that if you've got like a lotto play. If you're like, I don't know, this might do something, maybe even 0.5% is appropriate, depending on what you're looking at and what your risk tolerance is. Next after that, we've got medium conviction plays, which I would say are the majority of plays in a portfolio generally. You might have a lot of high conviction plays, but there's only so much that you can invest in. So at some point, you've got to build a curve like you are getting graded on a test in college. And whatever that ends up being, it is what it is. But generally, we want to be in the 5 to 10% range. For high conviction plays, we really only want 1 or 2 of these in our portfolio just because of how much position size they entail. They can be anywhere from really 10 to 20%, but 15 to 20% is a good rule of thumb too. Then finally, we have plus ultra, which is maybe you have 1 of these. And honestly, I would argue that a lot of people don't have any of these. And it's certainly fine if you do. But again, there's still some math that you want to apply to this as we get into it. So now that we've got conviction kind of locked down on what it means and what percentages that we want to look at, why is there a range? Why do we have medium, which will be our target area as we look at this video? Why do we have a range of 5 to 10%? Well, the idea is that if you get in at 5%, if things go against you or something goes awry, you have a chance to augment your position favorably. Usually what that means is you're looking to lower your cost basis by averaging down. That's probably the most common thing that I've seen when looking at conviction and why you want to be a lower percent. Alternatively, you could gain conviction as time goes on. And so again, you can just double your position, even if it's averaging up. It still works, right? Where you're just averaging out that cost basis. But the idea is outside of laying on the floor and rocking back and forth in the fetal position when a position goes against you, you do want to maybe consider, what can I do? How can I adjust this? So the reason that you would want to look at, say, 5% to 10% is now you can augment your position by selling more CSPs, potentially cash secured puts, or just buying shares at a lower price. And by doing that, you are lowering your cost basis. In the case of selling cash secured puts, you're not only lowering your cost basis, but you're giving yourself additional downside protection. Assuming you're not doing this in the money, and even in that case, you are getting yourself downside protection, just not necessarily as much as if you had a $50 stock that dropped to 45 and you sold $40 cash secured puts for $1. That gives you even additional protection from 40 down to 39, and you're getting paid to do it. So it allows you to continue to play with your positions that you like, right? That you have conviction in, and potentially enter at a price that is way lower or anywhere lower than your current cost basis, and allow you to add maximum double your position size to 10% before you start to feel like you're actually stuck. Now, that doesn't mean that if you're at 5%, you automatically double your position to lower your cost basis. You can do 1% at a time, right? Especially if you're worried that something is going to continue to drop. Maybe you only get 6% and then 7% and then 8%, right? It can give you some time to play with the position, yet still generate income by selling options as an entry. Now, if you're doing this weekly, yeah, you might do that every week for a few weeks until either you change conviction and maybe you decide, okay, I want to get out of this, or continue and realize that, like, okay, we're finding a bottom and it's time to move back up. Maybe this is a good spot to be. And you've lowered your cost basis, likely not ever even getting assigned on the last couple of CSPs that you're selling. So I can tell you where I've done this are different stocks like Reddit in particular. I certainly have bought that on the way down. And you know what? Over time, as things are going back up, it feels great. I did a similar thing with Hood back when it was in the 30s and 40s and 50s. It actually had dropped in April all the way down as low as 28, which I think shook a lot of people. And now we're over 100, right? So like if you have conviction in that play, you can write it down, benefit doubly as it goes up. I'm pretty sure that's a word. Don't check it. Now, if you're in the high conviction category, same deal, right? You're just dealing with slightly different percentages, but that's why we've got a range. And if you go over that range, all of a sudden you really need to be careful adding any additional money to that position, because we ultimately don't know what's going to happen to any individual stock. There could be some sort of legislation that literally destroys a stock and brings it down to 5% of what its current value is. Seems unlikely, but it's possible, and certainly there are companies that have gone bankrupt over time. All we're really looking to do is protect ourselves across the year, right? Like, we're not looking to make these huge plays that are trying to anticipate some ridiculous low percentage chance legislation. That's not the idea. It's really just to hedge against market movement and sentiment changes. Now, if we look at the port size chart, we've got a list of what type of stocks we might be playing at these different ranges and what that means from a position sizing. So if we were to say that we have, I wanted to point at the screen, but I can't do that. Well, I guess I can, but the camera doesn't go far enough. If we were to look at a port size of, say, $1,000, which is on the lower end of what you can sell an option with, you're typically not going to be able to find many stocks that aren't classified as penny stocks to sell options on. So by default, this is very difficult to do. Now, in this case, you're probably going to break rules if you really want to sell options at all here. And my recommendation is honestly just DCA save until you get to a higher level of port size. Maybe $5,000, $10,000 are where things really start to open up a bit. Otherwise, by default, your max position size is going to take a larger percentage of your portfolio. So I think of all the things that I've got on here, ONS might be the cheapest. And at one point it was like $2, and right now it's maybe $2.50. So you could be playing $2 CSPs, but naturally that is a single contract is going to be 20% of the port size right here. Now, if it's a high conviction play, congratulations, it fits. But you're going to struggle with finding stocks that you can do that with that don't classify themselves automatically as high conviction. And honestly, that might be okay for you because of the port size. Now, as we get to $10,000, all of a sudden we've got $500 as a 5% position and $1,000 is a 10% position. That starts opening you up to some other interesting stocks like Ford. Archer is a popular one that we've been messing with on the Discord server. ONS, like we just talked about. Kohl's, although apparently it's squeezing this morning and is right now over 12, so maybe not Kohl's. But KSS has been one that we've played because it was in the range of 750 to 9 for a while there. And there's a bunch more that you could add. You could add Lucid, I know, although I'm not recommending. None of these are recommendations, by the way. These are just tickers that I'm familiar with and I know are in the range. Again, a lot of these may put you closer to the 10% port size, which is just how it goes when you're on the smaller portfolio size. And there's a lot of stocks that are just a lot more expensive than that. So key number one, don't forget, make sure you're selling options on stocks that you'd be happy to own. Don't just pick a stock because the price is in your range. Make sure that they're stocks that if you get assigned, you're like, okay, cool, that was all right. Because it's going to happen. That's how option selling works. There's nothing statistically protecting you 100%. So we get into 50,000, really starts opening up a lot more options for you to play with, which include things like HIMS, Bull, GME is still kind of out there for people every once in a while. Rocket Lab, although they're flying up, I'm not sure. There's a lot of puns when you talk about options. I can't really stop that. I'm sorry. But Rocket Lab's another one. NBIZ is another. tons of options in this range, and really like the $50,000 portfolio size is where you can have a lot of medium conviction stocks that are essentially dominating your portfolio. Get to 100K, the options continue to open up even further. Companies like Hood, ASTS, IBIT, where you can start making your way into some of the crypto plays with selling options there, though they tend to be lower premium, but if that's what you want, that's what you get. Starbucks, right? There's a whole lot of stuff there. Maybe Dutch Bros if you like other coffee options, although they don't have weeklies, they're monthlies only. 500K gets you basically open access to everything that you could want that don't get too crazy, right? So obviously that gets you into most of the Mag 7, Google, you've got Amazon in there, some other big names like Walmart, Apple, Tesla, right? That's where you get into some of the sexier stocks with really good liquidity as well. So you can move more contracts and more likely to be able to fill those when you get to that range. Finally, as you get into the $1 million port size range, you can start really messing with SPY comfortably. You could get a SPY contract if you want, or two, but they're going to be a large percentage size of that portfolio at 628 right now, last I looked. And 628 is going to put you at a $62,000 contract size for SPY per contract, slightly over the 10% size. But listen, a lot of this stuff is, you want to get close. You don't need to worry about exacts. And on average, you want to be in that 5 to 10% range. Same with QQQ. Meta is where you start getting a bit too expensive for that 10% rule to work. And unless it's a high conviction play, which it certainly could be, then maybe these can be bouncing back and forth. Lilly, another one that's typically in the $700-800 range right now. So now we're getting even higher in cost as we get to Costco. Cost is another one that I think it's right now in the, it might be up to like $900 at this exact moment. I'd have to double check. And Spotify, which I didn't actually realize is as expensive as it is, but another one that you can mess with in this range. Then finally, if you want to look at the super high end of 5 million and above, you get into companies like Melli, which is, if you're not aware, that my understanding is they're the Amazon of South America. I see people playing with them on occasion. I'm not recommending any of these, but again, just giving you some examples of things that are over $1,000. AutoZone, I bet you didn't know, is like a $3,000 a share stock. So you could play it in this range if you're a big believer. I'm not. I wouldn't touch it with a 10-foot pole because I don't understand the business well enough. But look at the chart one day. Like, it just goes up. That's kind of crazy. Netflix is another in this range. I remember when they were $400 a stock. I kind of wish I bought more of them back then. BlackRock is another that is on the list. I have no idea if BlackRock even has like any interest in options. You'd have to look into that because they're outside of my range of what I'm interested in playing. But this just gives you a couple ideas of what type of stuff you could look at if you wanted to mess around with options in these different buckets. So let's take a look at Hood, which is what I've got up on the screen right now. And I think it's a good stock to be looking at because we've had an incredible run up. And certainly if you've found yourself buying in at this level here, in this higher level especially above the $100 range, which was like a psychological resistance at one point where we were kind of bouncing off it. Well, I got to go a little bit further back here. We're all the way back here, apparently. We kept bouncing off $100 and closing below it. And now we're above it, right? However, we've got now what looks like a bit of a bearish pattern and some red days strung in a row, 4 of them, it seems. Although it looks like we're live again right now, so the market is trying to figure out where it wants to be with Hood. This could be an example where maybe you bought at 108, right? And you sold CSPs, got assigned 108, and you feel stuck because things have just started dropping. Well, if you stuck to the 5% rule for a medium conviction stock, and we'll just assume this is a medium conviction stock. I have medium conviction in this stock generally, don't currently own any of it, but I've certainly played Hood a little bit. You might find yourself looking at this and going like, okay, maybe this is a good spot because we're bottoming out potentially. And I want to look at adding to this position. Well, likely you could sell at the money $105 cash secured puts for potentially good premium, especially with the volatility we're seeing both right now over the last few days and literally right now on the screen. There's quite a bounce back and forth from 104 to, geez, 106 now, it looks like. It's always fun watching this stuff move live. Maybe a little distracting, I suppose. But you could use this now as a way to put a new entry in to Hood at, say, a 105 at the money CSP. And by doing that, you're protecting yourself down towards potentially, I don't know. Let's take a look. So if we take a look at the option chain for Hood, we can see that right now, live, that 105 is actually a pretty expensive premium. You're getting at the money, and this is when we're at 104,685. So maybe you want to look at 104 and be slightly protected to the downside. You could enter here for 240, which is going to take your cost basis down from 104 to 101.60. And by doing that, if your average was, I think we said earlier, 108, and now you're averaging down, you're giving yourself some pretty good downside protection here. And if they don't hit, well, you've actually just lowered your cost basis overall on Hood anyway, by whatever that is as a percentage of your shares, right? So this is an example of, I have medium conviction on Hood, maybe I think it's going to be 120 in the next month. So if I want to dollar cost average down a little bit here with cash secured puts, that could be a great entry. Now, if you're worried that it's going to go even further, even $100 a share here has pretty good downside protection, another 1% down to less than 99 if you're able to sell these at 108, right? And there's a lot of open interest and volume here as well. So these are the type of things that you would be looking at in order to right size that position if you're worried that there's going to be a short to midterm drop. And this will then enable you to sell covered calls at a lower price because your cost basis is dropping without having to worry about assignment below your cost basis should you sell a CC that's lower than what you could with a 108 cost base. Now, if we had like a worst case scenario here and we finished the week below 100 and you had a 5% position, and let's just for simplicity's sake say that you double the position with another 5% on $100 CSPs. Well, let's take a look at what that would do. You can see here that if we were to look at the price at the original cost basis we talked about of 108, we sold the put for 100, which less that premium is actually $99 new cost basis. Well, the average is now brought all the way down to 103. So if you expect the stock to now go to, say, 120 in the future or whatever it may be, you've given yourself a much better cost position base to play off of. And this is really important because 103.5 is going to give you a much better rate at new CCs than what the 108 does in the future, right? So you could sell then covered calls at, say, 105 very comfortably. So selling a 105 CC is great, right? But you wouldn't have been comfortable selling that originally at 108 because what if you're assigned? Well, now you're actually just locking in a loss. But with the new sizing being augmented to your mid-conviction levels, you've enabled yourself to sell covered calls at a lower cost basis, which just gives you more opportunity for the upside. And that's really what we care about in the end, is just always positioning ourselves a little bit better. Now, what I would recommend is when you find yourself in a position to start getting out at a higher rate, maybe you pare back a little bit, right? Maybe we're on our way to 120 and we get back to, say, 110. You could just straight sell shares for a profit, or you could sell covered calls on them. That's obviously up to you and how you prefer to do that. It all depends on what your overall strategy is. But at least now you've got shares that you can sell, lock in that profit, and just continue to ride on the other shares, selling options on the wheel strategy, which is what I like to do. So just in conclusion here, to wrap things up, conviction is important to determine what your sizing is for a position to begin with. And once you've decided what your conviction is, you can look at that sizing and give yourself a buffer to augment your position should something go against you that you didn't expect, but you know is going to happen eventually. Using those tools, you can't protect against every scenario that might happen, like legislation changes we talked about earlier, or administrations doing wild things in the stock market that nobody can predict, but it can give you some downside protection and help you hedge against the risks that are out there in the world. Hopefully you found this video useful and maybe it gave you some new perspective on managing your portfolio, your position sizes, and giving you some options should a position move against you. That's all I've got for today. We'll see you in the next video. Happy trading. Bye.